Hi, I'm Basira, a property investor, and my partner and we've successfully grown our property portfolio to over £1 million in under 2 years, and we're essentially documenting our journey to financial freedom. If you're interested in property finance, and you want to have a basic understanding of things like remortgaging, refinancing, mortgage advances, today's video is perfect for you. We're going to go into some of the pros and the cons and really hope that at the end you have a better understanding and understand how these financial tools can be a benefit to you. So let's dive right in. First off, let's talk about refinancing. So, what is refinancing? Refinancing essentially means replacing your current mortgage with a new one. You might be wondering, why would anyone want to do that, right? Well, there are a few reasons, like to consolidate debt, it could be for lower interest rates, it could be to move from a fixed to a variable. But I'm just mentioning the things that you may be like, what does this mean? So we'll take it in turn. So let's start with the first one, lower interest rates. So interest rates, they fluctuate over time. So if when you got the mortgage initially, it's high, and then over time it goes a bit lower, you may want to refinance to get a lower interest rate. Because a lower interest rate means paying less on your mortgage. So you'd want to save money, especially during the cost of living crisis, right? Two, changing the mortgage term. So you may want to reduce your overall mortgage term. So for example, if it was 35 years and actually you thought you want to reduce it to 25 years to reduce the overall interest you'll pay over time and save some money there, but actually on the flip side, you might want to extend this. Say if you started off with 20 years and you want to change it to 30, you may pay more interest over time, but your monthly repayments at the time will be less. So the third one is switching from a variable to a fixed rate. So a fixed rate is where your mortgage repayments essentially stay the same each month. So you know your mortgage repayments essentially, if it's £1,000 a month on a fixed rate basis, it's £1,000 for that term that you've agreed with the lender. Whereas a variable one essentially is the opposite. It fluctuates. So it changes from month to month. So depending on your circumstances, you may want to pick fixed rate because you know you like stability. So it just depends on what you're comfortable with and the market condition. The fourth one is consolidating your debt. So you may want to remortgage to get your, if you have it in various places, all into one place because it may be easier to manage. However, you need to be aware of the risk that if you're getting a higher debt out, it may mean that you're paying it over time for a longer period. You want to be aware of that. But consolidating your debts, it can simplify the repayments and actually mean that you're paying a lower interest rate as well in comparison to maybe you have a loan from elsewhere. So when you refinance, you'll need to go through the same process as you did with your current mortgage. So like affordability checks and your credit check. So take that into consideration. But you may find a better deal with a broker. So if there are any brokers out there, feel free to drop your name in the comments to help someone out, because I am not that. Now, it's important to mention that, there's some cost with refinancing. The things like valuation costs, legal fees, early repayment charges as well, arrangement fees. So on the early repayment charge, so essentially what this means is, so when you took out your original mortgage, there will be a charge in the event that you repay your mortgage early, because the banks don't want that. They want you to be able to stick to the agreement so that they can get the interest that they originally were expecting to have. So that's something to bear in mind if you were ever thinking of leaving your current mortgage deal. In regards to the legal fees, so since you're taking out a new mortgage, essentially you'll probably need a solicitor to go through that. Now, there have been cases where for myself, when I've had to go through a remortgage, I haven't had to if it's with the same lender. So you may maybe save some costs if you happen to get a good deal with your same lender. But if you're going to a new one, then there may be a chance that you'll have some legal fees to pay. So with valuation fees, your lender may require a valuer to come out to your property. It's not always the case. In my experience, I haven't had that when I've had to remortgage. Maybe I've been lucky. I don't know. But it just depends on a case by case basis. So some lenders charge a fee for arranging the mortgage, and this can be paid upfront or it can be added to your loan over time, which will mean you'll be paying more interest as well over time. And that's something that they will probably tell you at the time of you deciding whether to add those arrangement fees upfront or add it to the mortgage. Now let's switch gears and talk about mortgage advances, or a further advance as sometimes it's called. This essentially is where you take out money on top of your existing mortgage. Now, sometimes people use this for home developments. Maybe they have a project coming up. You want to get a new kitchen, you want to do an extension. However, some people actually also do this for consolidation of debt as well, to pay lower interest rates, similar to refinancing, or even to like venture out on some investments. So it really depends on your situation, but it is another financial tool for you to think about. So how does it even work? The definition really is a mortgage advance is essentially borrowing more money from your lender on your current mortgage. You're taking out more money on top of what you already have. So for example, let's say your property is worth £3,000 and you owe £150,000 on your current mortgage. If your lender is willing to lend up to 85% of the property's value, you could borrow an additional £105,000. So obviously there will be some repayment terms. So the interest rate on your current mortgage will differ to the interest rate on the further advance that you have. So you'd want to factor that into your budget to ensure that you can pay both your current mortgage and then the further advance as well. So having said that, there's some risk. So be aware that this would increase the amount that you're paying a month. So you'd want to factor that in and be aware of any further commitments that may be coming along the line. So in the application, sometimes when they ask, do you envisage your circumstances will change? That's the point that you need to think. Am I planning anything big? Am I planning to potentially, go on a big holiday? Am I planning to have kids? Am I planning just to, it could be to get a new kitchen. So these are some of the things that you want to take into consideration if you're thinking about getting more money out of the bank. So now that we've covered both, how does one decide between refinancing and a further advance? So refinancing is better if you want a lower interest rate, if you want to consolidate your debt but can't or don't want to add to your mortgage, your current one that is. Or if you want to change the terms, for example. So if you want to switch from the current interest rate that you're on, or maybe reducing the term of your mortgage, for example. And a mortgage advance is better if you don't want to lose your current mortgage deal that you got because it's sweet and you're happy with it, or you want to borrow money for an additional project that you have going on. And now what I will say is always speak to a mortgage advisor to find the best solution for you, for your personal circumstances and your financial situation. Because I am not a mortgage advisor. I'm just telling you some of the things that I've learned along the way. I always would say definitely get a mortgage advisor to further advise you, or to advise you, I should say. Now, so refinancing and mortgage advances or further advance, whatever you want to call them, they both can be really useful financial tools, but it's really important for you not to rush into it and to make sure you understand both fully. But once you get your head around it, it can be really powerful tools for you to use, like once you have equity in your house. And if not, it's something to know going forward if you're just about to get into the property ladder. And if you want to learn more, there's some books that I'd recommend. And the first one is How to Buy Your First Home by Phil Spencer. So that's a good read to be able to understand from beginning to end, including mortgages. And another useful tip is the moneysavingexpert.com, and just Google or YouTube, like what you're doing right now. And the last one I would say actually is Rich website, because that really goes into the different types of mortgages there are as well. And I found that really useful when I started looking into this, like say maybe 10 years ago. And that is essentially the difference between refinancing and a mortgage advance or further advance, or however you want to call it. Now, I hope you found that useful. But again, if you want to know more about property investing or building your property portfolio as well, there's a link in the description for you to check out that video and let me know what you think in the comments. Until next time.